Hello friends! In this video, we'll explore one of the most profitable trading strategies with a high win rate, the imbalance formation. You'll learn how major market players leave their traces on charts which remain unnoticed by most beginners, and how to use these signals to open trades with high profit potential. We'll show you a step-by-step action algorithm and real setups that work across any market, whether it's cryptocurrency, stocks, currencies, or commodities. Yes, oil and Bitcoin might move differently, but the principles of price formation are the same. And in practice, you'll see that this strategy truly works. If you're just starting your journey in the crypto world, or are already an experienced trader looking for more insights and want to be in the right environment, check out our Telegram channel. You'll find the latest news, promising investment projects, and a free trading chat with analysis and trades from the pros. Don't wait! Click the link in the description and join our crypto community. Now, let's understand what imbalance is. Simply put, it's a gap zone on the chart that appears between the wicks of 3 consecutive candles. The color of the candles doesn't matter. In a bullish scenario, the upper wick of the first candle doesn't reach the lower wick of the third, creating an empty space, a signal of sudden market activity. What does this mean in practice? Buyers suddenly became active, sellers couldn't react in time, and the price literally skyrocketed, leaving a gap between the wicks. Such a zone is either an area where no trades took place at all, or their volumes were so small that they got lost in the overall movement. The reason for imbalance is the actions of major players, banks, funds, institutions. Their orders are so large that the market can't adapt quickly, resulting in a sharp price jump. This is the moment when the market tries to digest the sudden volume. These zones on the chart become strategically important for further analysis, because the price often returns to these areas to restore balance and provide a fairer value for both buyers and sellers. Simply put, the market strives to put itself in order. When analyzing a chart, one of the first steps should be to look for imbalance zones. They literally reflect the movements of large capital, and following the actions of institutional players significantly increases the chances of successful trades. To avoid confusion, let's break down the key terms related to imbalance. They are most commonly referred to by the acronym FVG, Fair Value Gap, or a gap in fair value. These zones are also called price inefficiencies. In contrast, effective pricing looks different. There are no gaps between candle wicks on the chart, and the price is evenly distributed, offering fair value. Despite the different names, all these terms describe the same situation, a gap on the chart caused by an imbalance between supply and demand. From a pricing perspective, imbalance acts as a sort of magnet for price. The market usually seeks to return to such areas to restore equilibrium. Additionally, imbalance represents a strong support zone. When the price reaches these levels, a noticeable reaction is expected, after which the market is likely to continue moving in the direction of the current trend. For traders, these zones become excellent opportunities for opening positions. Now let's look at a chart from a smaller time frame. Here, another imbalance can be identified within a larger one. This pattern is common. Price inefficiencies manifest on both larger and smaller time frames. Finding intersections of such zones allows for more accurate prediction of the level where the price will react. Repeating all actions, the internal imbalance again acts as a magnet for price and a support zone from which positions can be considered. It's important that this zone was marked this way because the range between the swing levels below the imbalance has a higher priority for price movement. As is known, higher time frames have a greater impact on the market than lower ones, and this rule is confirmed here. Consider the following situation. Starting from the upper candle, there are active sales by major players. The selling pressure is so intense that it significantly exceeds demand. This is a clear confirmation of the formation of imbalance, which can be highlighted on the chart from the low of the previous candle to the high of the next one. Its appearance is an early and quite strong signal of the start of a downtrend. The market usually strives to restore the disrupted balance before continuing downward, leading to a decline into the area of the lower imbalance. After rebalancing this zone, the uptrend gains strength again. Now let's see how a bearish imbalance scenario develops. We observe a sharp price drop into the hourly and 15-minute imbalance zones. At this stage, the price temporarily pauses, filling the gaps, processing previously unfilled orders. After this, the uptrend continues its movement. The examples you see demonstrate universal laws of price movement applicable across all markets, whether cryptocurrencies, stocks, or commodities. Mastering this concept will allow you to predict major price movements in the future with a high degree of probability. Let's now explore how to correctly identify an imbalance within another imbalance. Here, a time frame grid adaptable to the specific market situation can be useful. For example, to refine a monthly imbalance, it's most logical to use weekly and daily time frames. Delving into smaller intervals may reduce the effectiveness of the analysis. We apply the same principle to other frames according to the table. Let's take an example of refining a monthly imbalance on a daily time frame. This approach not only narrows the potential zone of interest, but also enhances the accuracy of forecasts. You minimize risks and increase the likelihood of successful trades. This method allows you to focus on key levels where a price reaction is most likely to occur. Thus, you avoid random searches for a reversal point on the chart. Similarly, we proceed with other frames. We switch to smaller time frames to refine zones of interest, and then apply the obtained data for detailed analysis and decision making. Now, let's discuss how to choose the most suitable imbalances for trading. On the chart, you can often notice a situation where two bearish imbalances form as the price falls. At first glance, they may seem equally important, but the correct choice depends on their position in the market context. To assess the potential of each, refer to the concept of premium and discount zones. How to do this? Draw a Fibonacci grid from the high where the fall began to the low where the correction formed. The 0.5 level in this grid represents the balance line, indicating the fair value of the asset. Everything above this level belongs to the premium zone, areas where the asset's price is overvalued, while everything below is the discount zone, where the asset is traded at a discount. In the premium zone, major players such as funds and banks aim to sell their assets profitably before further price declines. Therefore, the second imbalance, located above the 0.5 level, usually has greater potential for payoff. It is supported by the actions of major market players and is much more likely to lead to a price reaction than the first, located in the discount zone. It's important to remember that the market always strives for equilibrium, returning to the 0.5 level. This is the zone where supply and demand are balanced. Ignoring zones in the discount market not only reduces your risks, but also enhances overall trading efficiency by increasing the risk-reward ratio. This approach allows you to focus on more promising trades that yield stable results with greater profits over the long term. In the case of a long scenario, the approach remains similar, but here we are solely interested in buying. The most advantageous entry points are in the discount market zone, where assets are traded at undervalued prices. We skip all imbalances encountered during the correction that are located in the premium market zone, as the probability of them being successfully addressed is extremely low. However, if an imbalance simultaneously covers both the premium and discount zones, it becomes quite interesting. Such cases are quite common. The optimal strategy here is to work only with the part that lies below the 0.5 level, as it becomes our first zone of interest for opening a long position. If the imbalance is deeply situated in the discount market zone, it will become our backup point for opening positions if the price does not reverse from the first zone. This approach helps minimize risks and significantly increases the probability of a successful trade. The chart shows how the price consistently tests the marked zones, bouncing off key levels and forming an uptrend. This clearly demonstrates how well-defined zones of interest can aid in accurately predicting the market's future movements. Summing up the zones of premium and discount, it's important to note that this approach falls into the category of conservative strategies. However, it's worth considering that sometimes this method may lead to missing certain opportunities when the price moves too aggressively and does not return to the fair value level within a correction. Nevertheless, despite this drawback, such an approach provides more stable and predictable results over the long term. If your goal is stability rather than chasing every price movement, this strategy will be your reliable ally. Now let's move on to the next important stage, creating a simple and effective trading setup based on the imbalance formation. In the table we mentioned earlier, you can see successful combinations of time frames suitable for analyzing almost any chart. For example, starting with the daily time frame, this is where you should conduct the main work. At this stage, the overall market direction, key liquidity pools, and zones of unfilled imbalances are determined. Then you move to a lower time frame, in this case hourly. Here the task is to refine the daily imbalances, search for reversal formations, and enter the trade. Such a sequential and structured plan allows for frequent and high probability setups based on the logic of market movements and the actions of major players. We will later break down each of these steps in more detail. You'll learn which factors to consider before opening a trade, how to correctly choose entry points based on price imbalances, and how to wisely place stop losses and take profits. The first and perhaps most important step is determining the market direction on a higher time frame. To do this, you need to analyze the market structure, taking into account unfilled imbalance zones and untapped liquidity pools. Consider an example where the chart shows an uptrend consisting of 5 candles. The key elements to focus on are the latest higher high and higher low. They form a trading range that sets the boundaries within which the price is currently correcting. It's interesting to observe a situation where there's a downtrend within an uptrend. This is a phenomenon you'll encounter regularly. Such movements are often initiated by major players to attract more liquidity to the market. Buy orders accumulate above each high and sell orders concentrate below each low, which are removed during the correction. These orders are used by large institutional investors to open long positions and subsequently increase the asset's value. Support for the trend by major market participants indicates its strength and relevance. That's why the next important step is to determine the end of the correction cycle and the targets for further growth. Next, you need to identify key price levels. In our example, these are equal highs and lows. Such levels are artificially created to attract money from less informed traders to the market. These funds are then used by smart money to achieve their goals. It's important to understand that from the perspective of smart money, such levels are not support and resistance in technical analysis, but zones of critical liquidity concentration that will inevitably be breached. Liquidity is the driving force of any market movement. The market moves cyclically, transitioning from one liquidity zone to another, creating patterns observable across all markets and time frames. To better understand this dynamic, it's necessary to study the concept of internal and external liquidity. This will help you clearly understand how and why the price moves, which is key to stable and profitable trading. Consider a classic uptrend. Its structure highlights areas of external liquidity, while internal liquidity includes all swings between the current higher low and higher high. The mechanics of an uptrend are simple. First, external liquidity related to buys is removed, forming a new high. This reduces the available funds in the market and creates a need for asset redistribution in the opposite direction. During the correction, the market performs two main tasks: removes internal sell-side liquidity pools and eliminates previous price inefficiencies. These actions encourage traders to open new positions positions, filling the market with the liquidity needed by major participants to continue the initial movement. The cycle concludes with the price moving to a new zone of external liquidity, after which the process repeats. This is a dynamic based on changes in market liquidity. It's important to remember that after external liquidity is taken out, the price tends to move towards internal liquidity and vice versa. This cyclical process can be anticipated. Based on this, we can expect the price to move towards internal liquidity pools, followed by a reversal, and the asset rising towards external liquidity zones. To refine these forecasts, we add a third step in the analysis, identifying available imbalances that will become zones of interest for opening positions. The first imbalance is in the discount zone and includes key factors that enhance its significance. Above it are internal sell-side liquidity pools, providing major players with an excellent opportunity for active buying at favorable prices before the trend continues. The second imbalance is bearish, formed within the current price range. Its appearance signals the intention of institutions to lower the price further, which can be used for short-term short positions with the main goal of returning to the first imbalance. The third imbalance is located above the external buy-side liquidity zone. It represents the first problematic area on the upward movement path where a price reaction can be expected. This zone will likely lead to a correction during which internal sell-side liquidity pools will be taken out. Thus, just a few steps allow you to build a high probability price movement plan to work with in the coming days. We anticipate a rebalancing of the bearish imbalance and consider opening short positions. Within the bullish imbalance, we look for a reversal and open long positions. We expect the last high to be updated and the area of the third price imbalance to be reached as our key target, from which we again consider short positions. Next, we will move to a lower time frame and discuss what needs to be done in the zones of interest to increase the likelihood of success. Switching to a lower time frame plays a key role and allows for solving three important tasks: refining the zone of interest identified on the higher time frame, confirming the reversal, and most importantly, finding the optimal entry point for the trade. Using the 15-minute time frame as an example, the first step is to refine the previously marked imbalance zones. This helps significantly narrow down the areas of interest where we will expect price reactions. After this, you can adjust the trading plan made on the higher time frame. For example, for a local short position, we will aim for the zone of minute imbalance, where a reversal is highly likely and the price will start to decline. The target in this case will be the start of the 50-minute bullish imbalance, which could serve as a zone for an upward reversal. To confirm the reversal, we focus on three main factors. First, the removal of buy-side liquidity. Second, a sharp price drop with a break of structure. Third, the formation of a new bearish imbalance, signaling the start of a downward movement. Even if a structural break doesn't occur, the bearish imbalance itself is a sufficient early signal of a reversal. In this case, place a limit order to short at the start of the zone of interest. Set a conservative stop loss beyond the last high and a take profit at the beginning of the 15-minute bullish imbalance. Partial profit taking can occur when internal sell-side liquidity is removed. This approach allows for a risk-reward ratio of 1:6, which is an excellent result. In practice, the price often moves between institutional zones of interest and trades are completed within a few hours. You can consider two approaches to opening long positions: aggressive and conservative. In the first case, place a limit order at the beginning of the 15-minute imbalance and a stop loss below the low of the second candle on the 4-hour time frame. The targets will be the nearest previous high and the beginning of the bearish imbalance. Here, we rely on analysis without waiting for reversal confirmation. For a conservative approach, it's better to wait for a local structural break and look for a long entry point during the correction. For example, after a reversal and the start of a correction, the main target becomes the support zone in the discount market. On the 5-minute time frame, refining zones adds precision. Often, a small price inefficiency is visible within an order block, and reaching it signals a reversal and an opportunity to go long. Each order block on lower time frames should include zones of interest as they provoke price reactions. Successful testing of an order block involves three key stages: removal of sell-side liquidity, a market structure break in the opposite direction, and the formation of a new zone of interest from which to enter a trade. Place a limit buy order at the start of the imbalance zone. There are two approaches for a stop loss: aggressive, below the nearest low, and conservative, beyond the last swing where the setup loses strength. Targets can be set both at higher time frame levels and locally, such as at the last high where the correction began. These setups based on multi-time frame analysis show high accuracy and effectiveness. Simple yet powerful steps to help you find profitable entry points. If you have any questions, rewatch the material and leave a comment. We'll definitely help you understand. And remember, any strategy should first be tested on a demo account. This will strengthen your skills, boost your confidence, and improve results. Now, an important reminder: if you want to stay informed about all events and not miss the best opportunities, our Telegram channel is your ticket to the crypto elite. You'll find top-notch analytics, hot news, and trades from professionals, all for free. While others are guessing where the market will go, you'll be one step ahead, armed with knowledge and a clear strategy. We explain complex concepts in simple terms, just what you need for confident growth. So don't delay, click the link in the description and become part of our crypto team. See you in the chat. That's all for now. See you in the next video. Bye.